was going through this.
Hi, everyone. Can everybody hear me okay? This is Tom.
Yeah.
Yep.
All right.
Good.
All right, great.
Yes.
Sorry, we had a little technical difficulty. It's a Monday morning, and apologize for running a few minutes late here. But really did want to thank you everybody for joining us. If you haven't already, if you wouldn't mind, at least while we're going through the presentation, mute your microphone, so that way as we go through, we want to give you as much information as possible, and then we have 10 minutes dedicated to questions and answers at the end of the presentation. I just think that will go better for everybody. So we've got a couple more people coming in here. And I think, Lauren, probably as they enter, would you just please go ahead and take care of getting those in? Okay. All right, so the topic for today is recession, right? So everybody has heard it in the news. If you're, I would say if you're at least 35, you've probably lived through a recession. We're going to talk a little bit about that today. We think globally that recessions, while they're this ugly word, are actually a good thing. They're actually good for the economy. They're good for investments, and really as part of a long-term plan, part of a normal business cycle that we'll get into and kind of show you some opportunities. So the whole purpose of this is to kind of give you some background on recession, and then some things that we think you should do, and certainly what you shouldn't do in a recession. If we just go to the next slide, we're going to talk about several things today. Just a quick little overview for any guests that are on here of who Chesapeake is. We're going to walk through a little Econ 101, talk about the business cycle and some indicators that we look at here at Chesapeake to really help shape the advice that we give you and the portfolios that we're designing. Then we're going to talk about the bull and bear market. 25 years ago, Tim and I used to write a quarterly newsletter, and it was called The Bull and Bear. And that's part of investing. It's part of every plan. We go through cycles, we go through bull markets, we go through bear markets, and we'll give you some information about that and where we think we're headed, particularly as the stock market, how it's behaving, how the bond market, how it's behaving, inflation, and then an economic outlook. Then we're just going to go through some opportunities as well. If you don't have a plan, obviously all of our clients have a plan, but if you don't have one, you certainly should get one. And then the last thing is just some things with what not to do in a recession. I think that's the most important thing. So quickly about CFA, obviously we were founded in 1998. We are fee-only fiduciary. I think there's 2, 4, 6, 8, 10, 12 in that picture. We are now up to 14. Laura, who is our tax manager on this call, is one of those new additions that we've added to really help clients on the tax preparation and the tax planning side as part of your financial plan. We always say we're one advisor, but you get twice the advice. Not only is it financial planning and investment management, but taxes can erode gains quicker than anything, and so we always want to make sure we incorporate those into your plan. And then we obviously do some small business accounting, bookkeeping, payroll services as well. We integrate, for those clients, we integrate that into our plans on the financial planning side. Yes, so here we are, all of our mug shots up here, and I think I'm just a little bit more gray than that picture, but new photos coming soon is the takeaway here. But we do have Laura, our tax manager, Lauren, who is our director of client engagement, Tim, my co-founder, and Matt Klein, who is our newest financial advisor, who's been with us for just over a year, and on his way to passing his CFP, Certified Financial Planning designation. So we're excited about that. So the first thing I wanted to talk about was this is the Econ 101. Take you back to college, and you learned about supply and demand, and as part of that, there's a business cycle. And in that business cycle, we have four main categories. There's the peak. That's the really the expansion that has run up, and the economy is firing on all cylinders. We have this period of time where there's a downturn, which is called a recession. The trough, which is a prolonged period of time of decreased economic production, otherwise known as gross domestic product. And then you have an expansion again. So it's just this general wave, the up and down of our economic cycle. And where we are right now is technically there's a definition for recession, and it's 2 consecutive quarters of negative GDP. So it's not declining GDP. It's not GDP at 5% going to 4.5, going to 4%. It's actually gross domestic product of, let's say, 3% that all of a sudden falls to a negative 1%. And then the next quarter, it falls to negative 2%. So there's 2 negative quarters. There's a lot of other variables that we'll talk about, but that is a kind of a strict gauge of deciding of whether or not we are in a recession. The takeaway I think that we'd like you to have is that recessions are normal. They are part of just the regular cadence, the ebb and flow of our economy, and it certainly creates opportunities. So we just go into the next slide, Lauren. Yep. So here's a lot of the variables that we look at when we are deciding of whether or not this is a true recession. Negative GDP, which I've outlined. Rising levels of unemployment. Now everybody knows. I mean, it's like the local Walgreens doesn't have enough people, staff to stay open, or you see help wanted signs everywhere. We are in an expanding employment market right now. We just had a terrific print in July of over 500,000 jobs added. 3.2 million jobs have been added through July of this year. Now, a lot of that is because we came out of COVID, and there was a big contraction in jobs. Hospitality and leisure is coming back, but it's not typical of a recession when you have increasing employment. It's typically the opposite. You have rising levels of unemployment. Typically falling consumer confidence. So there's surveys that go on each month that call around and say, how are you feeling? Are you gonna, are you planning on buying a washer and dryer this month? Are you planning on buying a new car? That consumer confidence and retail sales, our shopping habits, typically fall in a recession. We're seeing both of those hold steady and rise. A couple other indicators are high interest rates. I think everybody knows interest rates, the Federal Reserve has been raising interest rates this year. That is typically a cause and a sign of recession. High inflation. So in June of this year, we've hit the highest since the 1980s, 9.1% inflation. Prior to that, there were 2 consecutive months of over 8% year-over-year inflation. And that's just the cost of goods last year are on average 9% higher in June than the prior year. And then just kind of a little bit of flavor, when we talk about a recession, how long do these typically last? And the National Bureau of Economic Research says that most recessions will last a period of 9 to 18 months. Now, I don't think anything's normal in this environment. COVID certainly wasn't normal. I think when we look back to 2020, no one ever thought in March of 2020 that by the end of December of 2020, the economy would be doing very well, let alone the stock market being positive for the year. So we're kind of in this little odd economic cycle of we've got a lot of indicators that say, yes, we are in recession, but we also have a lot of indicators that say, no, we're not in recession. And that's those last bullet points. The labor market certainly does not look recessionary. very strong job growth. And if people have jobs, they're more secure. They spend their money on new TVs, new cars. On top of this, we still have a supply constraint in the economy. I know I've been waiting on a part for 6 months that we haven't been able to get, and I'm told it's another 3 months. So we all have stories about that. Consumer spending is still robust. We're heading into the back to school season. Those numbers are indicating consumers are not pulling back, and that's because they're employed. And if they're employed, they have money to spend. And the real estate market has been, probably the most impacted by higher interest rates. We were looking at interest rates sub 3%, which are now, above 5%. And that just creates an affordability crunch that people can't afford, to purchase a new home with the same dollar that they had a year or two ago because it costs more with a higher interest rate. Real estate remains relatively strong, although there has been some slowing, and we think it's more of a fundamental shift in our economy that the millennial generation, which is a very large generation that rivals the baby boom generation, are forming households. They're getting married. I know anecdotally in a member of my family is getting married. They couldn't book their venue for 2 years out because of the number of weddings that are planned over the next couple of years. And so the millennial generation is converting to households. So they're buying homes, they're buying a second car, they're creating families, which everybody knows children are very expensive. And those are all good things. So on one hand, while we think we've got some indicators that show we're in a recession, we really think that this isn't your typical recession. And we'll show you what the stock market has indicated with regard to that. This is just for everybody's edification here. We've had 15 recessions, and you think about each one of these significant events. Certainly the Great Depression, but does anybody remember the Asian flu pandemic? Recession of 1960, the Gulf War, we actually headed into recession. In the 2000s, we had the dot-com bubble that burst. That put us in a recession. We had the in 2007 through 2008, we had the subprime mortgage crisis, which was termed the Great Recession, and of course, COVID had put us into recession. So these are very significant events that in those moments, we felt very fearful, that a recession was going to do great damage to the economy, perhaps into the stock market. But after each single one of these, the economy is recovered. It's stronger than ever, and that's also reflective in the stock market. So if we just kind of take a look at, are we in a recession? Are we not in a recession? And what the stock market is telling us. If anybody's heard me say previously, the stock market always looks 6 to 9 months out. It's never really in the moment. It certainly reacts to headlines in the moment. You can see it up 1% or down 2% in a day. But really the long-term outlook is it's looking 6 to 9 months out. And so the market right now is in this period of time where it doesn't know what the rules are. And it likes to know what those rules are. If we go back to healthcare reform, tax law changes, the market becomes very volatile during those periods of time because it doesn't know what the rules are. But once it figures out the rules to the game, it starts heading higher again. This period of time, January through the end, really about June 18th, has been a very prolonged bear market. And technically, when any market or any indices falls 20%, that is considered a bear market. So again, technically we are in a bear market, but we're not used to this. So for 15 years, we've in essence had a raging bull market. We've had periods of time where the market is pulled back 20% over. In fact, we had one in 2019 when the Federal Reserve decided it wanted to raise interest rates again. But it was only real quick 2-month period of time where the market went down and then rallied right back up. So to have a period of time where the market has been down, seems like every single day for 6 months, is quite uncommon over the last 2 decades. Let me say we have a part of our client base and our friends and family who were 20 or 21 15 years ago are completely different place in their lives. They're 35, 36 years old, and all they've ever known is their 401k to go up because of this fabulous bull market that we've had. So when we take recession and we take the bear market, this is great opportunity, because despite all of the headwinds that we've had in the past, market crashes, prior recessions, the market has only ever gone up. I do want that last note there, June 18th, we believe might be, and we say might because we don't have a crystal ball to know what the future will hold, but we think that that's probably the low of this bear market. That doesn't necessarily mean we're going to go up, 20%, from here in a month, but at least we don't think we're going to go below that June 18th low. And the reason for that is there was a lot of fear and panic that week in the market. A lot of people just saying, get me out. I don't want to be invested, in stocks or bonds anymore. I just put me in cash. And you've heard us say, that's the wrong thing to do. We don't want to react to a moment like that. We actually want to use that as an opportunity and rebalance our portfolio, or use it as a new entry point to buy great companies. So we just go to the next slide. Yep. This is a great visual. I'm a visual learner, and I think when you think about where we are right now from a recession and how the stock market is reacting to it, imagine if we have this fishbowl and it's filled with water, and we were to drop a rock into that fishbowl. It's going to make a tremendous splash, and there's going to be water flowing out of the fishbowl. But what's also going to happen is there's going to be ripples, and that water is going to be unsteady for a little bit of time. It just doesn't stop and go away. And that's where our economy is right now. We've dropped the rock into the fishbowl. There's this big splash. The market doesn't really know what the rules are, so there's a lot of these ripples. Every little headline is causing uncertainty, but we don't think there's anything really to worry about. The sky's not falling. We'll certainly get out of this, and some of the great things that we've talked about as far as there being plentiful jobs is certainly one thing that can bring us out of this. Yep. So here's just some, kind of where we are now. The Federal Reserve has continued to raise interest rates to combat inflation. That's important. Nobody wants to pay 9% year over year for the cost of anything, whether it's fuel and airline tickets to vacation rentals to just things in your grocery store. We've all experienced that. High inflation can certainly send us into a deep recession and possibly possible depression. We don't think that's going to happen because we've already started to see the effects that the Federal Reserve higher interest rates have had. There's been 2 consecutive 75 basis points, so 0.75% rise in inflation rates. September and November, we expect there to be more. So what's changed? Right around mid-June is when the market now all of a sudden saw what the rules of the game are to be for the rest of the year, and that is higher interest rates, that the Federal Reserve was going to do whatever it had to do to calm inflation and to bring it back into a more normal range of, let's say, 3 to 3.5%. So in July, the stock market has rallied. The NASDAQ, 12%, S&P 500, 9%, the Dow Jones, 8%. In July, we added over 500,000 new jobs, as I mentioned. The unemployment rate fell to 3.5%. Housing demand is slowing, which the Federal Reserve wants, but it doesn't want to break housing. So we think that these interest rates will do what it needs to do to calm inflation, but at the same time allow those that need to and want to purchase homes to purchase them. And then, of course, we have had that technical definition of a recession, which was 2 back-to-back quarters of negative GDP for the first and second quarter of 2022. So this is a quick look back, perspective back to 1926 through December of 2021. Top 2 lines are basically stocks. The orange line and the green line are basically bonds. And as you can see, all throughout those periods of time, there's been different events, and the stock market has only ever gone up in that nice 45-degree angle. And we don't believe that this time will be any different as well. So some of the takeaways, the do's and don'ts that we want you to consider. The first thing is, trust the plan that you've put in place. We monitor your plans on a daily basis, and when we go back and we look at, I use a lot of the probability of success. So depending on what market environment we're in, if the stock market's down 20% or if it's up 20%, your plan is designed and structured to get through that volatility. And so while it's not immune to declines, if the market's down 20%, the goal would have your portfolio down significantly less than that 20%. And then as the market turns around, to capture those gains on the upside. It's also a great time to, just review your general risk tolerance. And, if anything has happened in your life that has created some uncertainty, we want to know about that, because then we can make some changes in your portfolio to put it right in line with any changes to your risk tolerance. Those things could be, maybe you have lost your job, or you're offered an early retirement package, or how about you're taking care of a family member that you weren't expecting to take care of. Those are all significant events that we want to know about. Performance is always a snapshot in time. It's a photograph, and that's why we like to look at that longer term perspective. If you look at your June statements that have come out, completely different picture than if we were to send out a July statement, because July the markets were significantly higher. Some of the other things in your plan and what we like to do is we like to build bond ladders. So in a rising interest rate environment, bonds mature, you get your money back, we reinvest it into higher interest rates. It's a classic investment strategy. It might be something that you don't realize that we're doing, but we do it on a daily basis for your portfolios. If we want to focus on building retirement income, so you don't have to dip into principal in periods of time like this, that you can rely on your plan, rely on the income that it's producing to provide the quality of life and the standard of life that you like. If you're in the middle of saving, we don't ever want to cut back on savings in periods of time like this. This is actually the best time to be saving more. So continue to max out 401k contributions, which are currently $20,500 for the year. If you're over the age of 50, you can do an additional $6,500. So that's up to $27,000 a year. As the market's been going down, when you have systematic investing, you're dollar cost averaging, you're buying more and more of those investments. So as the market turns around in that business cycle wave, you're going to capture significant gains because of that. So again, here's some of the opportunities that we think recessions create. One thing we do know is that as part of this recession, household debt is down significantly, and the belief is because of COVID, people were spending less, so they just paid down their debt, and they have significant amount of cash in bank savings and bank checking accounts. And so that's one thing we want you to consider, is that if you have significant amounts of cash, and we define that as more than 3 to 6 months of your household expenses. So if your household expenses are, $10,000 a month, and you have $30,000 in cash savings to $60,000 of cash savings, anything above that, you're going to want to look to reinvest that into something that has a higher rate of interest or a higher growth potential. And a recession, market volatility with a bear market creates those opportunities. You're able to find really good companies that pay high dividends, 3.5%, 4.5%, 5%, 6% interest, dividends rather, much higher than anything that you could earn in a bank savings account. I always give the analogy that not the analogy, but the fact that back in that credit crisis and the subprime mortgage, the U.S. Treasury's debt was downgraded from AAA to AA plus, and all throughout that, Microsoft's credit rating remained a AAA rating. And so I said, would say, would you rather invest in U.S. Treasuries at a AA plus or Microsoft that was AAA? And back then, if you had bought some Microsoft stock, you would have far outpaced anything that the Treasuries would have provided you. What we do on an ongoing basis is we're always looking to rebalance and reallocate your portfolio to make sure it's in line with your plan. And in moments like this, we could have a period of time where maybe you're 5% askew from your target. So if we want you in 60% stocks and you're now at 55, we will look that if it makes sense for you to reallocate maybe some bonds into some stocks and take advantage of that. And always, we are here, as your trusted advisor, as a fiduciary, which requires us to always do what's in your best interest first, to be that support system. That's why we're holding this seminar, and we've talked to a lot of you over the last couple months, but we wanted to make sure that anybody we weren't able to meet with at least heard from us with regard to the recession, and this bear market. So call us. Rely on us for any questions that you would have. Some other things to consider. These are just some general financial planning, topics that we discuss with all of our clients, whether they're 20 or 90. You need to review your budget. Just make sure that what you're spending money on in a recessionary environment, in an inflationary environment, matches the income that you're bringing in. Things like eliminating unnecessary expenses. So I just realized that I think I was paying $12 a month for HBO Max, and I haven't used it in a year. So I canceled that subscription and going to save a couple bucks a month. Those are things that we just want to look at. We always think it's a great opportunity to look at your property and casualty insurance, your homeowner's insurance, renter's insurance, car insurance. If you have 3 to 6 months of savings in your bank savings account, you should look at an increased deductible, a higher deductible on your auto policy and your homeowner's policy, because it will reduce your monthly or your annual cost of the insurance. You have to pay a little bit more out of pocket if you had a claim, but typically the payback for that's 2 to 3 years in the reduced premium that you would have. If you don't have a HELOC, H-E-L-O-C, home equity line of credit, we always recommend, even if you're retired, getting a home equity line of credit as a backstop. 50 to 100,000 if you have that equity in your home. It's great to just put it in place. Most of them are no cost whatsoever. And if you need it, an HVAC blows up and you don't want to sell your investments, or you don't want to take money out of savings, you can use your HELOC for that. It gives you some flexibility, and you don't have to make a decision on the fly, but it's still, you can take care of what needs to get taken care of. And then we just kind of threw in kind of a cute little thing about, your inflation buying strategy. I love buying stocks on sale, but I love shopping at Home Goods, TJ Maxx. I like buying shoes and house goods, home goods on sale, 25 to 30% off. That's a great thing to do in a inflationary environment. Always give the example of a washer and dryer. Typically, it's not sitting in the middle of your family room. It's tucked away in a closet somewhere, in the basement, maybe off the kitchen. A scratch and dent is a great alternative where you can save hundreds of dollars on things like that. So just think about your buying activity. That's one way, to take advantage of those opportunities in a recession. So what not to do? We always want to be proactive. We do not want to react to anything. We don't want to react to headlines. While they are scary, we know that. There's a lot of other things going on in the world. Geopolitical climates are unstable. We don't want to react. We want to rely on our plan and trust that this too shall pass, as it always does. We just have to get through it. And if anything, be proactive with some of the things that we talked about. Certainly, we don't want to decrease your savings. We want to maintain our savings or even look to increase. Even if it's 1%, we want to increase our savings right there and buy stocks or add another 1% to your 401k or your 403b, perhaps even your thrift savings plan. And then there's that 3 to 6 month example. We think a great alternative for cash in a bank right now is to buy U.S. I series savings bonds. The I in that U.S. savings bond stands for inflation. They are designed to compensate the bondholder for the current inflationary environment that we're in. The interest rate, the annualized interest rate on that bond is 9.62%. 9.62%, greater than anything that you could earn in a bank account. Now, there are some caveats with it. We do recommend you hold on to the bond for at least 15 months. So it's not something for liquid cash, but if you have money in a savings account that you're going to have 15 months from now, buying an I series savings bond is a great way to go. And if you have any questions with that, we're happy to walk through exactly what to do there. Okay, so first I just want to open it up to Tim and Matt just to see if there was anything you wanted to add to anything that that I discussed. If not, we can open it up to questions. And what I would say is, if you could keep your questions, generally speaking, to recession, inflation, the stock market. If you have something specific with regard to your plan, please call me, Tim or Matt or Lauren. Send us an email, and we'll follow up with the specifics to your plan. We don't want to be giving away any, certainly private information.
Yeah, I'll jump in real quick. As Tom was talking, I just kind of wrote down some things that I thought maybe I'd retouch on, things that I think that maybe you guys could rehear and think about. The first was when we're talking about supply and demand and this recession being a little different. There has been a lot of supply disruptions everywhere, and Tom talked about help wanted signs. I mean there are supply issues on the labor force. Been to restaurants and see open tables but can't get seated because they say don't have the staff to take care of us. I believe if this recession is a little different, while the Fed is trying to raise rates and help slow things down and the spending of the money. I think if we get the supply issue fixed, we'll have a lot more goods. I mean, the definition of inflation is too much money chasing too few goods. I think if we get the too few good part right, so we got a way to take care of this recession rather quickly if we can get the supply back in line. Also want to talk about pockets of strength. We see earnings announcements daily, especially this time of year, and you see pockets of strength. I mean, the travel industry is cruising, pun intended, I guess, and it's doing very well. Everybody's probably pent up demand there, and then there are pockets of weaknesses. Ad spending's down. Tech companies are hurting a little bit, probably from too many startups getting going. Finance, same thing with like the fintech. Also, Tom mentioned about the fishbowl and the water splashing out, and he talked about the panic and the fear in the market. Keep in mind that the market's not the recession. I mean, the market's not the economy, and the economy's not the market. The market does look 6 to 9 months ahead. Those panic times that we had, and hopefully that bottom is in, that we saw June 18th. The market has to go through a process. Has to go through a process of repricing things. There's a lot of tech stocks off 50, 60, 70, 80%. And there's a lot of other things that are hanging in there, but they still get beat down with the market. As we come out of recovery, we'll see bounces here and there in all pockets of it, but the stronger companies will survive and thrive through this. They'll actually take market share from the companies that aren't as good, and that's our hope, is that we can get into good companies and take advantage of this. Also want to talk about, reiterate the I bonds, the higher interest rates. Higher interest rates cause bond prices to go down, but through the laddering process of bond ladders, as we have bonds mature, we're able to take that fresh cash and go buy at higher interest rates. And that's really important. And these I bonds are out there. It's hopefully a temporary thing, but you should take advantage of it. Tom did mention reaching out to us, so we've got a couple articles we can share. I do want to say that we cannot buy the I bonds for you. It's not something we could buy at Schwab or through any broker or anything. It has to be done through treasurydirect.gov, I believe is the website. But we've got ways, we can share that with you. And then back to the bonds real quick. When bond prices drop, it really is a temporary phenomenon. The bonds will eventually mature at 100, and whether you bought them at 110 and they drop to 100 because that's where they're going to mature, or whether they bought them at 110 and they go down to 90, they'll come back up to 100, so long as they stay solvent and so forth. And again, I always say that's on us. We're the ones out there buying bonds that we think they can get to maturity, and when they do get to maturity, that's fresh cash that comes in, allows us to go buy more bonds. Our objective is to collect that interest, and keep collecting that interest, have the bonds mature, and then repeat. So again, I just wanted to just highlight those few things that I thought were very important, and just to reiterate them, just so everybody got a better understanding of really what is important here. I'm not sure if Matt has anything, and if not, I'll let Tom take back over.
Matt, did you have anything you wanted to add?
No, you guys definitely spoke to everything.
All right.
Pretty thorough.
So any general questions on recession, stock market, kind of where we see things going, anything like that anybody would like to ask?
I just have a quick question about the I bond. So you can only buy like a max of 10,000 for yourself and the spouse. Is there any other way that you can purchase more, like for your children?
Yeah, you can certainly purchase them for your children as well. The max is $10,000 annually, but there's also a neat little trick, I'll say, that you can get another 5,000 through a refund. And so as we cross over the year into 2023, and if we're preparing your tax returns, that's something that we'll bring to light, that instead of getting the cash back as a refund, you could get $5,000 refund in an I-Series savings bond. So that's another way to get a little bit more. But you can also purchase them for children. It would qualify as a gift, which is below the $16,000 annual gift limit. So everything is fine there. No tax consequences.
Tom, real quick, I'm sorry, Jen, to cut you off here, but any age requirements for buying for children?
No age requirements.
Okay, and one more thing, that's interesting point that Tom brought up about the tax refund. It is only August. I assume, Tom, it might make sense to withhold more if you wanted to take advantage of that, so you get a refund.
Yep, that's a great little strategy. Yep, absolutely. You could, if you wanted to do that, you could withhold a little bit more. we've done in the past is even you can make an estimated payment for $5,000, knowing you're going to get that that money back as well. As long as it comes back to you as a refund, you're able to you purchase that additional $5,000. So really, a couple could get up to $25,000 a year for themselves in the Series I savings bonds. Now, this is also something that we're monitoring because the Series I savings bonds, we say we would like you to hold on to it for 15 months, and there's specific reasons for that. One is every 6 months the rate refreshes based on inflation, and eventually inflation is going to come back down because of the Fed raising interest rates, and so the principal, or I'm sorry, the interest on that bond will also come down. So we're monitoring that, and we want to know all of our clients that have those, so we can alert when we think is a good time to sell those. The other thing is, if in the first 5 years, you can hold these bonds for 50 years. I'm sorry, 30 years, and we will certainly go through another inflationary time again. But if you sell those bonds at any time in the first 5 years, you have to give back 3 months of interest. And so if we're anticipating earning 9.6% interest, and then we get rid of it at month 15, we've still earned that 9.6%. We have to give back that 3 months, but we've still earned the 9.6. So that's why we say 15 months, 12 months plus 3.
I see. Thank you very much.
Sure. Great question. Thanks, Jen. Any other questions? Any tax questions? I will just say, one of the things that one of the other questions we do get is, how about the midterm elections? What impact might they have? I don't have a crystal ball to know what's going to happen, with the next election, but we're not anticipating any significant tax law changes right now. The bill that passed this past week on clean energy has some significant incentives and continuation for solar and renewable energy on your personal tax return, and also brought back the $7,500 credit for EVs or electric vehicles. So that's certainly something, if you're thinking about purchasing a new vehicle, you could get a $7,500 tax credit for that. And so the rules and the guidelines haven't been written. There's always some cars that are excluded, some that are brought in that you might not expect. But as we get more information on that, I think it's probably good. We're going to try to have these seminars once a month. We get a little closer into the fall, having a tax idea, a tax strategy seminar as well, where we can present some of the opportunities towards year end. Okay, I think somebody.
Yeah, I see a hand up. I don't know what that
JD.
means.
Oh, hey.
Hi.
Yeah. How's everybody doing? Yeah, I was questioning. So you were mentioning if you had anything above 3 to 6 months in savings, for example, that might be something to invest. Now, would you recommend this I-bond approach, or would you recommend like whatever the traditional approach? I mean, it's probably plan dependent, but it's just a large jump to go from like it's sitting there in cash to it's all in stocks and probably going to decline for a while.
Right. So I think one of the strategies, and I'll let Tim speak to this as well. One of the strategies we're doing, we want to ensure that you have that savings, and we don't want you to take, that money out of savings. That has to be there. So that's your emergency reserve. And that's why we also kind of pair that sometimes with having a home equity line of credit, because if you have that, that can also serve as an emergency reserve fund if you need it. The I-bonds are really good for the 3 to 6 months of expenses that you're probably not going to need that money in the next 15 months. Take that out of the savings as a supplement to that savings and put it into the I-bonds. You certainly can get it back at any time, but we recommend 15 months because of the interest, as I explained. But on the investing side, we've been given a great opportunity with this bear market and the recession to have high quality blue chip companies that are paying dividends, of 4, 5, 6%. And so, yeah, you're going to have some market volatility perhaps, but the market is at a depressed level. So, I don't anticipate it going down another 20%. I think the risks are weighted that we stay flat, we move slightly higher. We can go down a little bit. I'm not suggesting we couldn't, but while you're earning 4, 5, 6% in dividends, you've been given time to ride this out, because particularly in the energy market, a lot of the energy companies are providing fixed dividends, and they're also providing quarterly variable dividends. Some of them are yielding 9 and 10%, and that's a really good opportunity for cash that is outside of that 3 to 6 month window. Tim, do you want to add something there?
Yeah, I mean, the opportunity, and I know JD's young, and you should reach out to your advisor too, what's right for you and so forth. But the opportunity to buy some of these stocks that are beaten down, if you don't need the money tomorrow or the next day or the next year or even for 20 years, you're going to look at this opportunity as one that you're going to be, oh, remember when we bought XYZ at this price during that,
Right.
we go back to that. I mean, Microsoft's a $200 and some stock. Tom, was it $13 back in during the Great Recession? I mean, it was just pounded down. And being able to buy it at $13 back then and see it at $280 now is just, I mean, it's just amazing. For those that are older that maybe are a little more nervous about things, it's probably not the right thing to do. But having that balanced portfolio, and I think what Tom said is right about that 3 to 6 months of savings. Buying these I bonds does not preclude you from getting the money back. There are issues. I mean, you do give up 3 months of interest. So if you only hold them for 1 month, I don't know if you would actually owe that money or get back less. But
you just get back you have to give back the 1 month.
Yeah, get back the 1 month. So it's kind of like cashing in on a CD early. You just kind of give up that interest. So it's not gone forever. But yeah, I mean, it's kind of like that safety net. Well, you can leave it in your bank account making 0.5%, or put it in the I bonds making 9.6. And oh no, I need to use the money because of this. You can go get it out of there. It might take you a couple of days to get it out, but it is available. So it is a what. 96.62. I don't know. I think a lot of you were probably shocked at that when you heard about that. It's a big number.
The prior I bond was prior to the adjustment this summer was 7.12, which was still significant. So it went from 7.12 for the first 6 months of the year to 9.62 the last 6 months of the year. So quite extraordinary. It's a great opportunity, and like I said, it's backed by the full faith and credit of the U.S. government. It's U.S. Treasury bonds. The interest isn't guaranteed, but certainly your principal, is not eroded. Any other questions? Yeah, good question. Okay. Well, if there are any other questions, or if you have a question that you'd like to follow up with us, please do. Certainly you can call the office. Our information's on the screen. Lauren created this great little QR code. You can take a picture of that code with your phone. It'll go right to our website. We have a contact form on there as well. For any of those questions, we'll be happy to follow up. Or if you think that maybe you need a little bit more time and you want to have a meeting with us, we're happy to have a meeting as well. But I do want to thank everybody for joining us. This was our inaugural webinar. Thanks to Lauren for doing a great job with everything. Thank you for being here, and look forward. We're going to try to do this, maybe every month, every 6 weeks or so, on topics that we believe are relevant, in kind of the current environment. So thanks, everybody. Have a great day.
Thank you.
All right. Bye-bye.
Mm-hmm.